Hi, I'm Nancy Steenson with Steenson College Coaching. Welcome to this week's College Planning Tip of the Week. With me, as always, is Jack Wang. Jack, regarding loans, if a parent and student decide to pursue private loans, what should they think about besides the interest rate? What other factors should they consider?
Yeah, that's a great question, Nancy, because it's one that I get a lot. We've discussed federal loans, direct loans to the student, direct parent plus loans, which are loans to the parent. But there is this third category called private loans. So let's talk a little bit about what they are first. Unlike direct loans and plus loans, they're not from the federal government. Private loans are from private lenders, typically banks and credit unions, or some of these online lenders you may have seen advertisements for and things like that. And these loans are different because they're not from the federal government. So there are some advantages to private loans. For example, families can choose who to borrow. So they could choose whether they want the parent to borrow, like a plus loan, or they can have the student borrow, and typically it's with a cosigner. So parents are still on the hook, but you can put the name in the loan, the name of the loan, into the student's name with a cosigner, typically being the parent. You also have other options, like federal loans are only fixed rate, but with private loans, you can have fixed or variable rates, so you have a choice. Now, keep in mind that private loans are not available from just any bank. In fact, many major banks, names that you and I would have heard of and around the country, don't do student loans. So you can't just walk into your local bank and say, hey, I want a student loan, right? They won't do it. And some lenders won't do what's called like original loans, meaning you need to pay for college. Some lenders that do handle student loans only handle student loan refinancing. So you get your loan from somewhere else, whether it's a direct loan or a plus loan from the federal government, and they'll refinance that out, but they won't make that original initial loan. But you're right, so many families look at interest rate. When we shop for loans, right, whether it's credit cards or mortgages or car loans, what's the rate? What's the rate? How low of a rate can I get? And that is true for student loans, but that's not the only factor. In fact, there are many, many other factors that families want to consider besides just the rate. So for example, if you have to co-sign, there's something typically called a co-signer release, which is how long do you have to make payments for before the parent or the co-signer can just automatically get taken off. Well, for some lenders, it's 24 months, but other lenders, there's 48 months. There's also lenders that have lifetime maximums, or no, not lifetime maximums, but total borrowing maximums, right? So if you need to borrow $50,000 a year using a private loan, some lenders will allow that. That's $200,000 across 4 years. Others will cap you at $150,000. Some lenders have so-called multi-year approval. So you get approved once, and then you draw on it much like a line of credit. So you borrow for the first year, and then you sort of go back like a line of credit, and you borrow again for the second year, and you're already pre-approved rather having to refinance or reapply. So there are a lot of these factors involved. And I'm not saying that private loans or federal loans are better or worse than the other. Plus loans do give you a lot more flexibility on the way in, but where they lack is some of the legal protections that federal loans have. So for example, what happens if the borrower becomes disabled? What happens if the student passes away? Things like that. And there are often limits to the time that private loans have for deferment if you lose your job or something like that. So there can be real risks on the back end of these loans if something were to happen. Now, of course, we don't plan on things happening like that, but when they do, and inevitably it happens to somebody, you want those protections, right? So families do have to think about this. I will say this, you can mix and match. So for example, some families will say, as a parent, I'm willing to chip in X dollars per year. So for that amount, if I need to borrow, I'll use the plus loan. But anything above and beyond that we need to borrow, I'm going to co-sign for my kid. That's okay. Right? It's not an all or nothing proposition. So you can get kind of creative. There are about 10 to 15 factors besides just the interest rate that families want to look at. And I often tell families these other 10 to 15 factors are often more important than what the rate is.
Jack, that's great information. Thank you so much for clarifying that. This has been very eye-opening, learning about all the different types of loans. Folks, if you haven't seen the earlier episodes, just a couple of weeks ago, Jack was talking about the other two types of loans, well worth going back and seeing. Thank you everyone for joining us today, and we look forward to seeing you next week for our college planning tip of the week. Stay safe.